Good afternoon, everyone. I'm Pia Kåll. I'm CEO of CapMan. So at CapMan, we're a private asset house. We're an active owner, and we build value for the enrichment of society, for our shareholders, for our investors, but also more broadly in the society. If you look at us as an investment into our share, really what we can offer there is a liquid access to the unlisted market in a very broad spectrum, from real estate to infrastructure to private equity. We can also offer investment returns from our active value creation in those assets. In addition, of course, predictable growth from fee income, from management fees, from our funds, and with successful exits from our fund, also boost that with carry potential. So all in all, a very attractive dividend share, but also a way to be part of the green transition and building a sustainable society, because that's what we do in all of our investments. CapMan is one of the first private equity houses in Finland. We're founded in '89, been listed on the Helsinki Stock Exchange already since 2001, with some 30,000 shareholders. Today we are almost 200 employees, spread across the Nordics in 6 different offices and 3 investment areas. We manage 5 billion euros of assets under management, and more than half of that is coming from large international institutional investors outside of the Nordic region. But if we take a step back and think about, so what is a private asset company actually doing? How does the private markets fund life cycle work? So what we are doing in our work is we're raising capital from primarily institutional investors for a specific investment strategy in fundraisings. We use that money per fund then to invest in assets, be it real estate, be it infrastructure or unlisted companies, usually spreading the investments over a period of 4 to 5 years. And then for each of the investments, together with management or the plan for that assets, create value throughout our holding period, our ownership period, which is usually something between 3 and 6 years' time. When the joint value creation plan has been achieved, then we look for the next home for that asset. In other words, we make an exit, sell our share of it, and make sure that the company or asset continues in good hands. What it means for the fund investor is that that's when we realize the value created, and from a shareholder perspective, that's when you can see realized returns and carry potential. The investors that we have are primarily pension funds, fund of funds, trusts and family offices, and majority of these are institutional investors outside of the Nordic region. So 55% of our 5 billion assets under management are coming outside of the Nordics, and the rest then spread across the Nordics. This capital is then invested very broadly across different private asset segments, primarily in the Nordic region. So our real estate investments span value add funds, income-focused strategies. Our infrastructure is focusing on the lower mid-market infrastructure across energy, transportation, digital infrastructure, and in almost all of these investments, we are part of supporting the green transition in that specific industry. On private equity and credit side, we invest in unlisted Nordic companies, spanning across majority investments, minority and special situations, but primarily creating growth and growing companies from local Nordic players to international companies. So as I said, we're a fairly small company. If we look at our employees, 180 employees, but our reach then in society is much broader. So if you look at our investments, if you add together our portfolio companies, we have approximately 15,000 employees working in these companies, a total turnover of 2.4 billion euros. If you look at our real estate side, more than 200 properties, almost 9,000 tenants in those. So the impact we can have on the well-being of employees, tenants, creating jobs in the society is much larger than our own employee base. When you think about as an investment or as a company, really what we are, we're a home for specialized entrepreneurial investment teams who focus on then investments in real estate, infra, private equity, wealth advisory. And if you look at our result, what you see there is really that it's a management fee and service fee income from these operations and carried interest when we do successful exits from these funds. We also have our own balance sheet of almost 200 million euros that we invest primarily into our own funds. And in our profit and loss, then you see the fair value changes of these investments. And this is also an opportunity for shareholders to indirectly get access to the private market returns that we create in our funds. Looking at our shareholders, there in total some 30,000 shareholders, half of those are Finnish households, and also, of course, the board, the management team, key persons own as a bit more than 4% of our shares. We have set our vision to be the most responsible Nordic private asset company. And what this really means for us is that it's true active ownership, where we can combine in everything we do, the financial returns and driving towards more sustainable operating models. So if you think about small and mid-cap companies, it's really around accelerating growth, but doing it in a sustainable way with sustainable business models. In mid-cap infrastructure, it's being part of the green transition, but it's also growing companies there with sustainable operating models. In real estate, in opportunistic and value-add real estate, it's around transforming assets, extending lifespans, introducing energy efficiency and green building practices, and in the core real estate strategies, improving asset utilization and efficiency. And we believe that doing this hand-in-hand, financial returns and sustainability, we can create sustainable value for our investors, for our shareholders, but also have an impact in the broader society. Our strategy comes naturally from that vision statement. So what we're building on is really three competitive advantages, starting from delivering top investment returns in our funds, coming from active value creation, with our own teams being part of the value creation, integrating sustainability as a core theme in everything that we do, but also developing CapMan as a home for top performers where the best people in the industry thrive and develop. When these things are in order, we can grow our existing strategies and products, scale up them. We can also introduce new products to the market. And we are also actively looking at acquisition opportunities and inorganic growth for new teams to join our platform. We've set the ambition to double our assets under management to 10 billion euros during this strategy period. And although the market is turbulent, we are sticking to our growth ambition. The reason behind that is that we really see that also in these market situations that we currently have, the private assets market continues to perform well. And this is actually a market situation where you, if you look at the history, have usually been able to create the best fund vintages, creating the best investment opportunities. So yes, the increase in inflation, interest rates, overall geopolitical uncertainty, it is impacting through slower transaction market, slower fundraising markets, but we're still in a growth market and where active ownership can create value. If we look at what we have been doing and how we've been executing on our strategies throughout this year, if we look at the transactions, we've consistently continued to execute both investments and successful exits. So far during the year, 8 new investments across private equity, credit, infrastructure, and also real estate. We've done successful exits, 4 of them from private equity, credit strategy, and also from the real estate side. If we look at the core of our business, so the management fee business, service fee business, we see continued growth, which is a result from successful fundraisings. So over the last 3 years, our fee income has been growing on average 13% per year, but our fee profit has been growing 33% per year over this period, driven by scale efficiency in the operations. In addition, as I mentioned, we are investing our own balance sheet into our funds, and they are allocated in a very diversely across different asset classes and fund strategies. And at the moment, a fair value of 165 million in our investments. And if we look at the coming years, we expect to clearly see positive cash flows, which benefits the shareholders from these investments. A few highlights from the sustainability agenda. Of course, a lot of the work is being done with the assets on a very grassroots level, but lifting up some of the things. So we have set our emission reduction targets in line with the science-based targets, got them validated earlier this year, and also setting the net zero target during this year. It means that we will, in our real estate portfolio, reduce emissions per square meter between 50 and 70% until 2030. In our private asset and infrastructure portfolio, make sure that our portfolio companies have set their science-based targets and are on path to execute on that. If you look at the social side, employee satisfaction and job creation, both internally, our eNPS above 50, but also in our portfolio companies, a 76 out of 100 score on employee satisfaction during last year. And in addition, also in this market environment, creating jobs. So in our portfolio, we have created more than 2,500 net new jobs during the year. Also, this work is recognized in the overall benchmarking assessments. So in GRESB, that's assessing infrastructure and real estate funds, all of our funds that participated improved their scores during the year, and we now have 4 of our funds that have 4 out of 5 stars, and 3 of the real estate funds that are now at 3 out of 5 stars. So as said, we seek to double our assets under management, reaching 10 billion euros during this strategy period. Also, if we look at the current year, what we see is continued strong demand for our strategies, gross net intake of new capital commitments of 300 million, close to 300 million this year. And also looking forward, when we think about the next 12 months, we have several of our flagship funds coming to the market or currently fundraising with a very good solid appetite from our current investors, but also new investors into this. Looking at this then, from a shareholder's perspective, our long-term financial objectives, what it really sums up to is continued strong growth, above 15% average annual growth, solid, strong balance sheet, return on equity and equity ratio, and a distribution policy when the policy is to pay a sustainable distribution that grow over time. So to conclude, as I said in the beginning, if we think about CapMan as an investment, what you really get access to is a liquid access to the unlisted market, real estate, infrastructure, private equity, access to the investment returns from our active value creation in those funds, but also through the stable, predictable management fees and service fees from this fund, you get a predictable fee income, which is then boosted by carry potential and carried interest when we do exits from the funds. Both of these then adding up to an attractive dividend, but also, as said several times then, an access to be part of the green transition and be part of creating a sustainable society. Thank you.
Thank you, Pia. Please have a seat.
Yep.
So, yes, let's start with the market-related questions. So, yes, so we have moved from the situation where basically everybody has been forced to buy alternative assets due to the low interest rate environment. And now we are in the environment which somebody could maybe say a more normal one, where credit is actually a relevant asset class again. So how do you see this fundamentally affecting the demand on the alternative side?
Well, basically I see it as a slower growth. So I still see that the private asset markets in general it's a growing asset class. There are new investors entering the market, and there are a lot of investors, especially when we look internationally, who are not yet at their target allocations. So it's still a growing asset class, but it's clearly growing slower than it's been in the past couple of years. And I also see a shift towards more of the kind of value-add strategies. So where really the investment team with their own actions are then, say in real estate, for example, transforming the use of a certain asset or expanding lifetime, or in private equity where you are growing companies. So there where value is really created through the work. So more a shift towards those strategies than maybe the core strategies where, like you said, then maybe kind of credit instruments are giving the same returns but with a lower risk profile.
Yeah. What about the real estate? It's your biggest asset class, obviously. Do you see that since the credit rates have been rising to a more normal level, that the attractiveness of the real estate assets would have come down when you compare it to the credit and the zero interest rate environment?
So I would still see that the attractiveness of that asset class is still there. But what we do see, obviously, across the board in the market is that with higher interest rates, I mean, there is a revaluing in the market. So the values of real estate are coming down. You can look at it from two angles. It's an opportunity, and we're definitely looking at it as an opportunity where we have dry powder in our funds, and there will be assets coming to the market that are not able maybe to refinance, or where the owners just need to sell. And then you have the other side of it where of course the assets we already have, and there a large share of our real estate is value add. So for example, say we had, like one case we had in Copenhagen, where you buy a warehouse and you sell it as a high-end office location. So even if both valuations come down, we're still creating value in between. So in those, less of an impact, but clearly in the income strategies, we also see a dip in valuations there.
Then about the fundraising market, you are planning to launch several new major funds during the upcoming 12 months, even though the fundraising market is very difficult at the moment.
Or maybe it's more normal.
Yeah, maybe, yeah. But it's more difficult than it was, let's say, 2 years ago or so. So what gives you the confidence that you'll be able to raise so much capital on all of these funds during the next 12 months? If the market situation just magically doesn't improve a lot there.
Yeah, so we are not counting on that the market would magically improve or change very much in the next 12 months. But what we are kind of basing our decisions on, so each investment team is obviously constantly having a dialogue with their current investors and getting an understanding on if there is the support for the next fund or not. And of course, launching the fund, timing it so that there is a support for it when it goes out. Also, what we've seen in the market now, so it's more difficult, but actually what we see is that it's slower. So on the investor side as well, this uncertainty on where the interest rates will land and uncertainty on how much inflation we will have and how the transaction market is developing, it's actually making just processes slower. So we see the demand is there, the interest is there. Maybe we get new investors in with slightly smaller tickets than we had planned, but they are still interested and they are supporting us. So in that sense, comfortable and comfort around the new funds that we are raising, but the timeline difficult to say in this market.
What actions have CapMan taken to prepare for increased interest rates? And this question also continues, how are you prepared for possible rate decreases? Because it's kind of two sides of the same coin, I guess. Exactly. But yeah, let's start with how well were you prepared, or how did you prepare for that?
For the interest increases, I think one of the things that helped us is that we've been quite moderate in using leverage across all of our investment strategies. Some of them don't use at all leverage, like the growth equity strategy, for example, but in real estate and in general in private equity, the debt levels were never really maxed, so they were quite moderate, which means that also a rate increase is still, they are still kind of not over leveraged. And then of course it goes down to really investment by investment, that the investment team there stays close or is all the time in close contact with management, in close kind of preparation, so that you proactively start to take measures on it. So it goes down into really, really the kind of daily handiwork of the team to take care of it.
What about the possible rate decreases? Would that have any effect on your day-to-day?
I think that would probably be a positive problem to handle.
Yeah. So what is the major bottleneck, in your opinion, at the moment in the private asset space? Obviously, there is a bottleneck in sales. Is it more of the over-allocation thing that managers have basically, some managers have or investors have over-allocated? Or is it more, as you described, the uncertainty about where the interest rate land, what is the inflation, how the economy pans out, etc.? So
I think it varies quite a lot between different investors. So I think some might have truly over-allocated a bit when there was the last couple of years kind of hype years, and they need to balance out. Some had an issue maybe say a year ago or so when the stock markets came down, that a denominator effect that their private allocations suddenly looked too large because they were performing and the stock market wasn't. And then I think what I hear the most at the moment from investors is really a cautiousness around liquidity. So when the transaction market is slower, the returns or distributions back to investors is slower and not coming exactly at the time or the pace that they had expected. At the same time, everyone is preparing for that maybe the capital calls are coming faster if you have assets that are in trouble or need more financing at the moment. So a cautiousness around liquidity, and I think that one will start to solve itself when we get the transaction market going again. Then there will be a lag. And one step back, I think now soon or when we start to get a common view on where do interest rates kind of plane out or how do they start to behave, at least not continue to increase, then I think buyers and sellers will start to have the same view on values on assets. We get the transaction market going. Then there will be a lag before those transactions actually happen and close and money is actually flowing back to investors so that they get the confidence back. And then I think the fundraising will pick up again.
Yeah, so then the wheel starts to spin
then it will spin again. But of course, that will take at least a year probably before you have the full wheel spinning again.
Yes. So why to keep such a big balance sheet? I guess you have fairly large balance sheet.
We have fairly large balance sheet. Well, and some claim it could be even bigger. But I think there's a couple of reasons, or depending on from what angle you look at it. It's a really beneficial and a tool that we can use when we launch new investment strategies and when we kind of raise new funds that we are investing alongside our fund investors. They see that as a vote of confidence that we believe in the product, and that way eases fundraising. What it also means is that we can use it as a tool in fundraising. So if we're raising the next generation or vintage of a fund and we have an investment in the previous, if you have an investor who want a larger ticket size, for example, or want to balance risk, we can sell out some of our investment in the previous fund so that they get a little bit of the older fund and they invest in the new fund and they get a broader mix on it. So it's really a way for us to accelerate fundraisings and build value. If you look at it from a shareholder point of view, it's also a way that we create then returns from those investments also for our shareholders, which is also part of our distribution policy to then pay out as dividend those distributions.
Yeah, so
it's creating value from both scaling the business, but then also for shareholders.
Or in actual returns.
Yeah.
So you are very confident with your current size of a balance sheet, basically. Yes. Then dividends. Why did you change your dividend policy?
So exactly for maybe part of the reasons that we just went through. So what we changed was from an annually growing dividend to a sustainable distribution growing over time. And if we look over some years ahead, I would say that cumulatively what we are planning to pay out to our shareholders will not differ that much between the two policies. But what the new policy is enabling us is actually to, well, if we have really successful exits and distributions from some fund, we can pay it out that year. But also it allows us to use the balance sheet then to grow new funds or inorganic growth if we have those opportunities. So it gives us more flexibility, but the thinking is to still over time or over the next years pay out the same amount as with the old policy.
Yeah. So I guess the point you want to highlight is that the cumulative dividend should
Cumulative dividend shouldn't change, but it can be more volatile between the years.
And it gives you flexibility to execute
and
the strategy.
The reason to do it is to build a business so that overall we grow and create more value.
Yeah. Speaking of inorganic growth, you have actually stated also in the financial targets that in order to reach a 10 billion, you actually need M&A there. So the question is actually, Cap has talked about M&A a long time. Why you haven't made more on the M&A front, and what is your stance on M&A today? But let's start on the why hasn't more happened during the past. I mean, obviously you are not guilty on everything there, but
then yes, and I would say so that there's a lot that has actually happened. There's very little that we've been able to publish so far. So there is all the time a lot of ongoing dialogues and discussions. But obviously, what we're talking about here is acquisitions where we add a specific investment theme or kind of investment product to our portfolio. It's a people business, and it's all around finding the right team at the right moment where they benefit from joining our platform. So these processes obviously take time, and they are primarily bilateral one-on-one discussions. So far, and that's then the limitation of being stock listed, that before names are in the paper, we can't say that much more than that there is a lot of discussions ongoing.
But obviously your stance is that you are
actively
looking and keeping more than eyes open, basically.
And I would also say that in the current market environment, when on one hand fundraising is slower, and then also regulatory pressure is increasing or regulatory requirements are increasing, we actually have a benefit to offer to smaller standalone teams in both that we have a professional fundraising organization, but we also have our platform expert services that can support on everything when it comes to regulatory and reporting, etc. So let the investment team focus on investments and kind of consolidate those kind of requirements that needs to be met.
How about the valuation M&A front? I mean, if we scroll back a couple of years ago, well, the private assets were the only game in town, so to speak, and the valuations were sky high. So how has the valuations developed? Have they come down to back to earth now, or?
I think it also depends on what segment you look at. Yeah. So in the lower mid market, where we are mostly active, they never really skyrocketed. You had some sectors maybe that skyrocketed, but in general they stayed. So hence they have also stayed now. Yeah. And then maybe more what we see is that really in the larger deals, in the large cap side, it's been difficult to get financing, and that has pushed valuations somewhat down and maybe just made those transactions not yet happen. So I would say it's more slowing than that we really would see a rebasing of valuations yet.
Then finally, about the changing market environment, your third, you could say, earnings engine is the carried interest. So has your carry outlook over the long term changed due to the fact that we have had this kind of drastic change in the market situation?
No, so I think if we look at this year, we realized carry from our growth fund exactly as planned, and not so much the total volume of carry that we expect, but timing. Once again, carry only realizes when the transactions happen, and if the transaction market is slower, it means that also when the carry happens is more uncertain timing-wise.
So yeah, the carry is coming, but it takes more time.
It takes
basically.
More time. Yeah.
Okay, this was all from my side. Thank you, Pia, very much
for
your answers. And now, next we have United Bankers on stage.